Hey, Saretsky here. As always, Canadian real estate market update with a particular focus on Vancouver. If you're getting sort of value or entertainment out of these videos, all I ask you hit thumbs up and subscribe. Questions, comments, put those below. We're going to have some fun in this week's video. I am loving all the comments and the hate coming in. I'm getting dogpiled on Twitter for my views on monetary policy, central banks, the Bank of Canada in particular. As you guys know, last week, if you watched last week's video, I kind of joked about the Bank of Canada, Scotiabank's forecast for the Bank of Canada to raise rates. They said they will raise rates 8 times. And of course, we had the Bank of Canada out this week with an update to their monetary policy. So let's clip in our good friend of the show, Tiff Macklem, right here.
If the inflation does end up being more persistent than expected and more persistent than in your inflation forecast, should Canadians expect then to see a faster pace of rate hikes?
Of course, it's all going to depend on exactly why it's stronger. But what I can assure Canadians is that we have been and we will continue to adjust our monetary policy tools with the aim to achieving our 2% inflation target on a sustainable basis. And what you saw with this morning's announcement, we now think the slack in the economy will be absorbed more quickly than we previously thought. We now think it'll be around the middle quarters of next year. So if you want it in months, sometime between April and September.
So Tiff Macklem's now saying, listen, we're going to review our monetary policy framework and we're going to start raising rates sometime between April and September. Again, extremely vague. Now the markets are basically trying to force the Bank of Canada's hands by basically right now I think they're pricing in 5 rate hikes by the end of 2022. So couple important caveats. Basically, the Bank of Canada is coming out and saying, at least in their monetary policy update, that essentially that they're lowering their GDP forecast. So growth is actually going to slow down. They're going to basically start tightening into a slowdown. Growth is going to slow. Inflation is going to get back to their 2% target by the end of 2022. We'll see. And that they're now going to begin raising rates slightly sooner. Now everybody's saying, you have to remember, I want to sort of preface something as I dive into this and explain this a little bit further. The whole purpose of this channel has always been, listen, it's about financial education, it's Canadian content, and we analyze things. I've probably been one of the largest skeptics of central bankers, the morals of low interest rates, zero interest rate, helicopter money. If you go back and look at my videos at the onset of the pandemic, into the early stages when the Central Bank of Canada was doing $5 billion of quantitative easing per month, $5 billion. That I was saying, listen, this is going to have massive repercussions. Housing was going to go up. Of course, it went up, 25% nationally. So I've been in the inflation camp well before really everybody else has been jumping on board. I mean, even your neighbor next door who doesn't know anything about financial markets is talking about the cost of living and inflation going up. So it's almost becoming taboo. And so now that everybody says, well, inflation is above the Bank of Canada's target, surely they must raise rates, right? And that's basically what the market's trying to tell you. Hey, inflation's up, they have to raise interest rates. And now people are getting all upset because I'm not in that agreement. And they go, well, you've got inflation, you have to raise interest rates. What I'm trying to sort of get through to people, and I don't really have a whole lot of interest in convincing somebody of something, but it's like, listen, here's my view, could be wrong, but here's what myself and the smart people that I talk to that work in markets every single day, bond traders, some of the smartest people in the financial world. We've got a podcast with Keith Dicker at IceCap Asset Management. We've been running a global macro fund for 30 years. Rich Diaz, who's been writing, advising institutional high net worth individuals. We detailed this at length in the podcast. Certainly go check out the Looney Hour, which will be the best podcast in Canada over the next 18 months. Basically, you have a system that's on life support. We should be raising interest rates. So people get all upset because they're like, these idiots are taking on all this debt. They're leveraged up to their eyeballs. They think they're brilliant investors because their houses are going up, and that pisses a lot of people off. People get very upset because it's been the dumbest trade ever and it's worked. And people that aren't in that trade, they get upset and they think, well, listen, these people took on all this debt. I'm here being prudent, making smart investment decisions, saving money, and I'm falling behind. And so they want rates to go up and normalize because that's kind of like the moral thing to do. It's the right thing to do. It's kind of like, let's reset the system. Like, I'm so sick of this. We need to get this back down to normal. And it's like an internal thing that they want to happen. But what you want to happen or what is the right thing to happen doesn't mean that's what will happen. I'm strictly looking at this from a central banker's politician level view of like, listen, we've got the math. I mean, the math is Canada's total non-financial debt to GDP is 343%. That's the math. And the math suggests to me that positive real interest rates will, in fact, quite literally bankrupt the private sector in Canada. And so that's just the math. So the math is that real rates must remain negative for a prolonged period of time in order to basically, you have to have a situation where GDP, economic growth, GDP, grows faster than the debt levels. That's just the math. So unless you're talking about a total reset of the financial monetary system, the Great Reset, which again, maybe that's the policymakers' path. Maybe that's where they're going with this. I doubt it. I think they're going to do everything they can to keep it on life support, like they've been doing for the last 13 years with zero interest rate policy and QE. So you're telling me that suddenly central bankers are going to have this moral compass come to Jesus moment and normalize interest rate policy? I don't see it from a political standpoint. And so when you see these central bankers like Tiff Macklem come out and say, hey, listen, we're going to start raising rates. We're going to get, we will fight inflation, as if he really has any control on inflation. His whole job is forward guidance, right? Forward guidance is one of the largest policy tools in the central bank's quiver. It's like they will tell you what they're going. It's like a government. It's like Justin Trudeau or Aaron O'Toole in the federal elections. They'll say what they need to say. They will promise you some crazy policy to change and make housing affordable. But when they actually get in, like nothing actually happens. But they say what they need to say to get the objectives complete. And so that's the same thing that the central bank does, is they do forward guidance. Just them talking about ending quantitative easing, just them talking about raising interest rates, just them talking about not being accommodative, it starts to change the animal spirits in the market. And it starts to tell markets that they start pricing in these interest rate increases. Like all we have to do is go back. Guys, this is so simple. Let's just go back to the onset of the pandemic. What did this guy say? Let's clip in right here.
Our message to Canadians is that interest rates are very low and they're going to be there for a long time. We recognize that Canadian businesses are facing an unusual amount of uncertainty. And so we have been unusually clear about the future path for interest rates. If you've got a mortgage, or if you're considering to make a major purchase, or you're a business and you're considering making an investment, you can be confident that interest rates will be low for a long time.
Remember, this guy went on to say, listen, he was begging. I did a video on this at the start of the pandemic when Tiff did this conference. This guy was begging people to go and borrow money. He begged them. And they made that credit available at the commercial banks. They were pushing the commercial banks to pump out mortgages, and that's what they did. And that's why I said I was bullish on housing, because you had messaging like this coming out of Tim Macklem and Co., and you had the federal government guaranteeing loans. There was no risk for the commercial banks, so they pumped out credit. And so this guy at that conference said that they wouldn't be raising rates till at least, sometime in 2023. Now all of a sudden we're talking about, 3, 4, 5 rate hikes in 2022. Talk about the ultimate rug pull. Let's go out and encourage people to go borrow money. Let's expand credit to get out of this economic downturn, and let's rug pull them, 12 months earlier after they just gorged on a mountain of debt. National home prices up 20+%. That's the ultimate rug pull. And what I'm saying now is he's now giving you forward guidance that, hey, we're going to fight inflation. We're so tough. It's just words. It's just words. Don't ignore the words. Look at the math. I don't care that inflation's going up to 3, 4, 5%. The math is simple. The debt to GDP, the system is completely insolvent. And this is not just a Canadian phenomenon. People say, yeah, well, it's Canada. Let them blow up. Like, we made our errors. Like, again, global debt to GDP, 365%. Let's look at U.S. debt to GDP, U.S. total debt to GDP, the world reserve currency, 350% of GDP. The U.S. government, true interest expenses, which is basically the government's interest expenses on all their debt is higher than government tax receipts. What does that mean, Steve? What does that mean? It means that they don't collect enough. The U.S. government, for example, doesn't collect enough in tax revenues to pay to service the interest on their debt. So they have to continue. They're basically issuing new debt. They're issuing more new debt to pay the existing debt down. That's Ponzi finance. That is the definition of Ponzi finance. And now you have to keep in mind that U.S. tax receipts are where they are today in a good economy, in a market where you have the U.S. stock market at all-time record highs. If the stock market drops 30% because you tighten rates and you stop doing quantitative easing and you crush asset markets, U.S. tax receipts will then fall, it only increasing your debt servicing ability. You just make that debt pile even more unsustainable. And you start talking about the solvency of, for example, the U.S. government. And the same can be said in Canada. So I have to laugh because I get, these guys coming out on Twitter and Facebook and they go, oh, look, you sound like a realtor, you better go sell all of your investment properties before it's too late and interest rates go through the roof. And it's like, listen, all I know about myself is I have a better balance sheet than the federal government. My balance sheet is much better than the federal government's. I take in a lot more money than goes out. Rates could go up 10%. I won't even flinch. It just won't. Okay, sure, my house reprices on paper and it drops in value. That's fine. It's for me to live in. I'm not selling anytime soon. If rates go up 10% on the federal government, you tell me what's going to happen. If rates go up 10% on corporations in Canada, what's going to happen? Okay, hey guys, we're struggling to pay our debt here. We have to make some cuts. Sorry, you're out of a job. And so you're going to have like mass employment, this Great Depression type scenario. So like these people that are actually cheering on rate hikes are saying that like I'm against them because I'm trying to like increase the value of my own portfolio, don't understand the existing financial system and where we are. It has nothing to do with me. It has everything to do with the actual system. I would love it if rates go up. I've been the one that's been talking about it on this channel for years, that listen, low rates are creating wealth inequality. They're creating social divide. They're a huge reason why house prices in Canada are where they are at. They'd be great, raise rates, but I don't actually think that's how politicians in the system works. I mean, I try to keep my emotions out of it. And so, as we get back to talking about balance sheets, I mean, let's talk about the municipal governments. So, for example, the The provincial government, all the provinces in Canada, basically took bailouts at the onset of the pandemic. They couldn't fund any of their debt. Could not fund it. The markets would not. Yields went way up. So all of a sudden the provincial government's borrowing costs went like this. Because why? Because there was risk in the market. And so what happened is the Bank of Canada had to come in, buy the provincial government's bonds, supply them with funds, lower their interest payments. I didn't ask the government. I didn't take any government money. I didn't need anything. My balance sheet's fine. Provincial government did. You'll remember the city of Vancouver, where I live in, the guy was on TV begging. He was begging for a bailout. He begged for a bailout in the event of a crisis. So interest rates going up, stop thinking about Canadian households and people borrowing too much money for the houses, which is totally true. It's not about the households. It's the governments are the ones that they're bankrupt. They can't stomach higher servicing costs. It's the corporations that employ you that can't afford higher interest costs. So that's really what I'm trying to explain today. And again, if you want to agree and disagree, that's fine. Everyone's entitled to their own opinion. I tend to find that I end up arguing the most with the retail crowd. It's the high level, people in finance that have been moving money and working in credit markets for 20 years that I don't have to have that conversation or argument with. It's like, yeah, we know, it's like, rates will go up 50 basis points, 75, and something will blow up, and we'll have to reverse course. And so it's this thing that I want to also just to kind of summarize this video is just to re-emphasize things. The Bank of Canada now owns 46% of the Canadian government bond market. They own half the bond market. There's no buyer for this government debt at 1%. They're bankrupt. And so the Bank of Canada is going to step away and just let rates do their thing. Since middle part of 2019, the federal government, the Bank of Canada has funded about 90% of the budget deficit. Whatever debt has been issued by the new net debt issuance from the federal government has basically been entirely absorbed by the Bank of Canada. They're funding the Bank of Canada, okay? And so you're telling me that suddenly the Bank of Canada, Tiff Macklem, has a moral compass and says, you're on your own, Trudeau. You're on your own. You're on your own. If you want to go spend money to help Canadians and free daycare and affordable housing that you want to buy and all this, if you want to do all those programs, you're on your own. You're telling me that the Bank of Canada is just stepping away? That they're going to let rates go to 3, 4, 5%? It's just not reality. And again, so my view here, let me be clear. You're being lied to. It's an illusion to show you that, to suggest to you that there's still some life left in this monetary system that we're in. That the central banks can actually normalize rates and nothing can go wrong and they can unwind the balance sheet, and it's just fairy tales. You're being lied to, and Scotiabank coming out and telling you there's going to be 8 rate hikes, at the same time telling you that they're bullish, that the outlook for Canadian house prices is up and to the right. You're being lied to. I can tell you, if Scotiabank is accurate in their forecast, that if they're accurate in their forecast that the Bank of Canada gets 8 rate hikes in, great. But I will guarantee you this, as someone that sells and buys and invests in real estate will not be going up if you get 8 rate hikes. Prices will come down 100%. So you're being lied to. It's one or the other, Scotiabank. Either rates are going up 8 times and housing is coming down. It's not both. It's not both. And so, as I look forward here into the next, 6 to 12 months, I think that we're setting ourselves up for a policy error. And the policy error is not, the policy error is going to be thinking that the economy can actually handle meaningfully higher rates. I think that the Bank of Canada will get in 75 basis points before something blows up. And I think that blow up will probably be a slowdown in the housing market. It might be national home sales start to slow, mortgage rates go up to 3%, and prices start to decline. And housing start to decline, and that's such a massive component of GDP that it's like, oh Nelly, start to back up. So that's kind of my view. And I would, again, I always welcome the comments in the comment section, because at the end of the day, this is the community that we're building. I am not the holy gospel. I will be wrong. Maybe I'm dead wrong on this, but I just think at the end of the day, it's math. We all learned it in high school, and the debt numbers don't work. And you have an economy, you have a financial system that has been built on higher asset prices, that those assets are being levered against other assets. They're being collateralized against all these other assets, that a repricing of those assets just blows everything up to smithereens. Lending shuts off, the credit tap shut off, and you just get this massive deflationary wave. And so, people talk about inflation, and I think it would be pretty easy to quell inflation. Yes, there's some global supply chain issues which can't really be fixed, but hike rates, 100 basis points in the next 6 months. I guarantee you asset prices will drop, and you'll send this wave of deflation rippling across asset markets, across the economy. That will stop your inflation problem pretty quick. We'll be talking about deflation then. So anyways, so I got this week. I highly encourage you to check out the Loonie Hour. Again, we're going to make that the best podcast in Canada in the next 18 months. We got some really, really smart people. The sort of financial education piece, the view that we have for that is really exciting. There's going to be a lot of educational pieces. We just want to be this resource to help Canadians, because we all see the stuff that we're being spoon-fed from the liars at the Bank of Canada, the liars at the federal government, the liars at Scotiabank. And again, maybe they're well-intentioned people, and it's best that they say what they need to say. But our view here is, listen, we want to help people protect their capital. We want to help people make investment decisions, better their lives, and that's that's what I started this YouTube channel 5 years ago, and now we're morphing into an extension of that through the podcast. So as always, appreciate your support. See you next week.